Okay, Assalamualaikum and a very good day to all of you. My name is Siti Nabila binti Muhammad Syari. I will be your lecturer for course MAF 253, the Introduction to Financial Management. So we're going to start off the first week of our lecture with chapter 1, which is the Introduction to Financial Management. These are the topics that we're going to cover for this session. Before we begin, I would like you to have your textbook in front of you as a reference as we go along with the slides. So we're going to first touch upon the definitions of financial management, which is followed by the areas of decision making. We have three types of decision making. One is investment decision, two is financing decision, and the third types of decision making is asset management. After that, we're going to discuss some of the important parties in financial environment, followed by the responsibilities of financial managers. We're going to end our chapter 1 with a brief discussion on goals of firm. So what is financial management? The word finance, or in Bahasa Malaysia we call as keuangan, can be described as the process by which money is transferred among businesses, individuals, and governments via the financing and investing activities of these parties. Okay, so we can categorize the finance into three types. The first one is personal finance. It refers to individuals' finance activity. So, for example, like me, I have my own personal loans in which I use to buy a house and cars, and then I also pay the money to the governments when I pay my tax. I also pay a certain amount of money to the businesses when I do my shopping or business transactions. Okay. The second category is the public finance. We are referring to the financing activity used by the governments. Okay. Government receive money through the tax which they have collected, and then they use the money that they have collected to invest in the country by via the infrastructure or the public services, and also as well as paying wages to the public servants. The third category is finance, corporate finance. So MAF 253, you're going to cover only on the area of corporate finance, in which the area deals with the making of money related decision within the firm. Okay, so it means that how does a firm get their money, and how does a firm invest or spend their money. Okay, under the area of decision making, okay, the three areas of decision making that a financial manager often do is the investment decision. It means that they need to determine how they are going to use the money that the firm has, such as does the company need to buy new assets? Does the company need to buy short-term assets such as inventory? Or do the company need to pay short-term expenses such as the wages, the bills, so on and so forth? That's what it meant by investment decision. How does a company spend their money? And then before they can spend the money, they need to find a way to find the money. We call that as a financing decision. So the company can either obtain financial needs by borrowing from banks, or they can issue securities so that they can borrow from the public. Okay, the third decision is the asset management decision, in which the asset that they have purchased previously, they need to be able to manage the asset in the efficient and effective way. So in this chapter, I'm not going to explore the third area of decision making, but we're going to revisit this in chapter 4, the management of current assets. Okay, so we're going into the first area of decision making, which is the investment decision. These are the example of decisions to be made by the financial manager, such as how much asset should the company buy, and what type of asset should the company buy, and is this investment necessary? Okay, this investment is, should I sold off the old assets? Should I sell off the old assets, or should I maintain the old asset after I bought the new ones? Okay, so we have two types of investment. One is the working capital investment. The second one is the capital investment. Okay, working capital refers to a more routine purchasing that the company made, such as when they want to purchase inventory. Okay, so inventory is a routine investment, and it's being done perhaps in daily basis or maybe in weekly basis. Okay, and the effects are very critical because with the inventory, the business operations cannot go on. Okay, capital investment is referring to a non-routine activity such as the purchase of assets. We do not buy assets such as machinery or vehicle every day, every week. We only buy it when we deem it to be necessary. So we call those kind of investment as a capital investment. Okay, the effects are normally critical, very critical. The second area of decision making is the financing decision. So the word financing decision means how does a company obtain their funds that they needed to do their investment decision. So we have two sources of finance. One is the company can either borrow, they can either borrow in whether long-term or short-term manner basis. Okay, so the borrowing the company does can either borrow from financial institutions such as banks, or the company can also borrow from the public by issuing security such as bond or debentures. Okay, if the company doesn't want to go to the borrowing methods, they can also go to the equity financing by either issuing new shares, or they can use their reserve. Okay, so what is retained earning here? The word retained earning here is the profit that the company has accumulated over the years. Okay, so the total profit that they have is known as reserve. And if the company don't want to borrow, or doesn't want to borrow, or doesn't want to issue new capital, they can always use their available reserve for their future expansion projects. Okay, let's say that the company wants to buy an asset worth 100,000. Okay, so the company can either borrow 100,000 from bank, or borrow by issuing debenture of 100,000, or the company can issue shares of 100,000, or they can use 100,000 for the reserve that they have. Okay, but the company can also mix them up, meaning that out of 100,000 of assets, the company can borrow 40,000 from bank, and then they issue shares 60,000. Okay, so this is what we call as financing mixture. It refers to how many percentage come from capital and how many percentage come from debts. Okay, so the different mixture leads to a different cost of capital, and cost of capital is important because we want to value our company. Okay, and once we have our if we issue shares, then we need to determine our dividend policy decisions. Okay, so if the company pay high dividend, then they will have lower returning. Okay, because if you recall your income statements, you pay off your dividend first, then the remaining you transfer to reserve into retained earning. So if your dividend policy you pay high dividend, then you will have low returning, therefore you may need to borrow more, and vice versa, meaning that if you pay low dividend, then you may have higher returning and you may not have to borrow elsewhere because you have a huge amount of reserve. Next, we're going to talk about the important parties in the financial environment. So for important parties of financial environments, we have financial manager, we have financial institutions, and then we have financial markets, and we have investors. So we have 4 important parties that you need to know: financial market, financial managers, financial institution, investors, and the financial markets. Okay, as we have discussed earlier, financial manager is the person who decide how to invest and where to get the money, which means the financing decision. So they can obtain funds from either financial institution or they can go to the individual investors such as me, you. Financial institution refers to the agent who channel public businesses and government loans, government saving into loans. It is they are the intermediaries, orang tengah, who receive money from the public through saving, and then they convert the saving that they have accumulated into loans, which they give out to individuals or another business entities. Okay, individuals refers to the me, you, who wants to invest in the company by purchasing securities of the company. The security is referring to the ordinary shares or debenture or bonds or preference shares, whichever they are offered by the company. Okay, so whenever the company wants to sell off their security, they have to conduct the transaction of selling and buying of the security here in the financial market. So we have 2 types of financial market. One is the capital market, the other one is money market. Capital market refers to the company security which have life more than 1 year, such as common stock, preference stocks, or bonds. Okay, and it's traded in Bursa Malaysia, Nasdaq, and MDAC. Depends on what types of security that you want to trade. Money market refers to the short-term security. They are very liquid, meaning that their life is less than 1 year. For example, like commercial paper, banker's acceptance. Okay, so these securities can be further categorized into 2 types, which are the primary market and the secondary market. Okay, for example, like common stock, it can be primary market when the common stock is being bought and sold for the first time, meaning that this is the first time the company issued the security and it is being bought by the investors. We call this as the initial public offering. Okay, and the investor, once they have the security, they can sell it off to another investors. Ali boleh jual kepada Abu lah. Ali can sell the security that he has to Abu. So when he resold the security, we call that as a secondary market, which means that existing securities are traded among the investors, either through the individuals, between the individuals, or financial institutions. So these are the 4 responsibilities of financial manager which you need to know. One is the forecasting and the planning. The other one is coordinations and control. The third one is investments and financial decision. The fourth one is dealing with financial markets. So forecasting means that it must have the ability to forecast the company's future performance, and they must lay their plan based on the forecast, and they need to interact with other executives, meaning the other manager in other branches, so that they can get the most accurate forecasting. Okay, it means which is related to the second responsibility, which is the coordination and control, which means that they need to interact with other departments because decision of other department might affect the investment decision. Okay, and then the third one is investment and financing decision. We determine the sales growth rate, determine what asset to purchase, determine the method of financing through borrowing or through equity. Okay, and lastly is dealing with financial market. Okay, this is referring to the Bursa Malaysia when you want to issue securities, you need to deal with the financial market itself. We need to obtain the market either to the capital or money market. So we need to decide whether to invest either asset in the financial market or not. Now we go to the goal of a firm. When we talk about the goal of a firm, in any kind of business that the company is in, the goal is always to maximize the profit. Okay, however, the goal of the firm in corporate finance is to maximize the shareholders' wealth. So now the question is, why isn't the goal of the firm profit maximization? So let us discuss the implication for each of the goal. So under profit maximization, our goal is to maximize the net profit to be as high as possible. So to achieve this kind of goal, we need to do everything that we can so that it is achievable within 1 year. Okay, within 1 year. So it is the time frame for this goal is a single period and it is a short-term goal. Therefore, it stresses on the efficient use of capital resources to ensure maximization of profit. What it means here is that we want to reduce our expenses so that we can maximize our profit. Okay, to get profit, revenue minus the expenses, then you get the profit. So we would like to reduce the expense in order to increase the profit. It means that that means we need to ensure the efficient use of capital resources. Therefore, financial manager may implement actions that will result maximum profit without considering the future performance. So any kind of expenses that they say cannot contribute to the current year's sale, they would make sure that the expenses incurred for that particular item will not be would be taken off. For example, like the company may cut off their research and development expenses, because for research and development expenses to yield any kind of sales, it takes years of results. It takes years to yield results. So they might cut off their research and development activities because they want to maximize the profit for the current year. However, without the research and development expenses, in the future, your competitor may take over your businesses or may compete with your products because of the lack research and development on your part, because you deem it to be worthless in the short-term run. Okay, therefore the drawbacks of this goal is it focuses too much on short-term goals, meaning that you only want to incur what will give you the current sales to maximize the current years of profit. And ignore timing of return. Okay, so if the project gives you a return in the later year, you may not want to take that project because you feel that the current year profit will not benefit for the project that will give you profit bigger in the coming years. Okay, and ignore risk and uncertainty. Okay, for example, like you have two projects. Project A gives you higher risk but also higher return, and the other project B, gives you lower return but at lower risk. So you might want that. So you may choose project A because of the higher risk, higher return without considering of the higher risk attached to the particular project. So because of the limitation given by the profit maximization, corporate finance says that the goal of the firm should be maximizing the shareholders' wealth. So how does it mean? What does it mean by shareholders' wealth? It means that the company must maximize the share price which is being traded in the current market owned by the owners itself. Okay, so the shares, the ordinary share that owner hold on is being traded at a certain price in the capital market. Okay, so we would like to maximize that share so that most of the wealth will be returned back to the owner. So the maximization of shareholders' wealth is based on the timing of return amount and the risk of the return. Okay. The share price is also affected by the expectation of the future shares as the economic environment that is beyond the management direct control. So sometimes the share price increases maybe because of the company's performance itself, meaning that the company generate high net profit, or the company pay high dividend, or the company shows saving in terms of their expenses. So because of this performance shown by the management, therefore the share price increase. But there are certain elements in which it's beyond the management control that also cause the share price to be increased. It could be because of the economic condition itself, the health of the nation economy, or it can perhaps goes to it can perhaps due to the perception that the shareholder has over the company that they want to invest or they have invested. Okay, we talk about the reputation, the goodwill of the company. Okay, so for example, some of the investors feels that the quantitative part of the performance is not as important as compared to the qualitative part. It means that they are okay if the company give higher profits or higher dividend, but what they concern most is the non-monetary aspect of it. For example, like maybe they concern about the company's priority in terms of the environmental aspects, such as the global warming, the corporate social responsibility, whether they give back to the society in which they have in which they operate their business on. Do they take care of the welfare of the employees? Yes, those are the non-monetary aspect that some investor might consider more important as compared to the monetary aspect. So this is what it meant by the environment that is beyond the management direct control. All this contribute to the fluctuations of the share price in the market. Okay, so you can see here under the goal of shareholders' wealth, the goal is more well-rounded. It doesn't only take into account the short-term net profit, but it also take into account the future performance, the future activities of the company, both the quantitative part, the monetary part, and also the qualitative part or the non-monetary part. Okay, however, shareholder wealth maximization goal has also several drawbacks. One of them is it is too long process. The process is a long-term basis. Okay, so if it's long-term, we have a lot of elements that is beyond our control, beyond the management control. Okay, the second drawback is that it doesn't offer any clear relationship between the share price and the financial decision. This is what we've discussed just now, that sometimes even though the company has shown good monetary performance, such as high net profit, high dividend payout, or efficient management in the expenses, okay, but the share price doesn't reflect to that particular financial decision. Okay, it has something that beyond the management direct control, such as the perceptions of the shareholders, their reputation, and their consideration to the society in which they have operated in. So it doesn't, we cannot see clearly the relationship. If we do more CSR, the share price will increase. We cannot see the direct relationship. Okay, so therefore it is something that the management found it difficult to control. So that's the end of chapter 1. So please look at the past years to tackle some of the theoretical questions being asked in the final assessment. If you have any question, you can ask me via the WhatsApp group, or you can DM through the Google Classroom. So thank you for your time and your patience and your attention.